For years, there was one number that mattered more than almost any other on Wall Street: growth, revenue growth, customer growth, market share growth, store growth, user growth. As long as a company was growing quickly, investors were often willing to overlook a lot of other things. Profit margins could be thin, spending could be high, efficiency could wait. Growth was the goal, growth was the story, and growth was often enough to keep investors happy. But in 2026, something is changing. A new business trend is quietly spreading through corporate America. It's showing up in boardrooms, investor presentations, earnings calls, and strategic planning meetings. And what's interesting is that this trend isn't about growing faster, it's about becoming stronger. Across industry after industry, companies are shifting their focus away from pure expansion and towards something else: resilience, efficiency, flexibility, and operational discipline. It may not sound exciting, it doesn't generate flashy headlines, but Wall Street is paying attention because the trend is becoming impossible to ignore. The reason starts with uncertainty. Businesses today operate in a world that feels increasingly difficult to predict. Consumer behavior changes rapidly, technology evolves constantly, market conditions can shift without warning, and economic forecasts seem less reliable than they once did. In the past, many companies built strategies around confidence. Today, they're building strategies around uncertainty. That difference is driving major changes across the economy. One of the clearest signs of this trend is how companies are spending money. A few years ago, aggressive expansion was common. Businesses rushed into new markets, opened new locations, expanded workforces, and pursued growth opportunities wherever they could find them. Today, many executives are asking tougher questions before approving major investments. Will this project improve efficiency? Will it strengthen the business? Will it remain valuable if conditions change? Can it survive a weaker economy? Those questions reveal a different mindset, a mindset focused less on getting bigger and more on getting stronger. Hiring decisions tell a similar story. America's largest employers still need workers. Many industries continue hiring, but companies are becoming much more selective. Instead of simply adding employees, businesses are focusing on productivity. They're investing in training, improving workflows, eliminating inefficiencies, and finding ways to accomplish more with existing resources. The goal isn't necessarily a larger workforce, the goal is a more effective workforce. That shift is happening across multiple industries simultaneously. Technology is accelerating this trend. Artificial intelligence is creating enormous opportunities, but it's also creating uncertainty. No executive wants to be left behind. At the same time, no executive wants to make billion-dollar mistakes. As a result, many businesses are taking a measured approach. They're investing in new technologies, experimenting with new tools, testing new systems. But they're avoiding unnecessary risks. They're making smaller bets, learning quickly, and maintaining flexibility. That approach reflects a broader shift happening throughout corporate America. Businesses are becoming more cautious about committing too heavily to any single future. Another reason Wall Street can't ignore this trend is because it's showing up in balance sheets. Many companies are holding larger cash reserves, strengthening financial positions, reducing debt where possible, and preserving flexibility. A decade ago, some investors may have viewed this as overly conservative. Today, many see it differently. Cash provides options, strong balance sheets provide stability, and stability has become increasingly valuable. When uncertainty rises, flexibility becomes a competitive advantage. Businesses understand that, and investors are starting to reward it. Consumer behavior is another major factor. Customers today are harder to predict than ever. People compare prices instantly, switch brands easily, and adjust spending habits quickly. A product that performs well this quarter may struggle next quarter. A trend that looks unstoppable can fade surprisingly fast. Businesses know this, which is why many companies are becoming less focused on maximizing short-term growth and more focused on building long-term adaptability. The ability to respond quickly is becoming just as important as the ability to grow quickly. Investors are noticing. Wall Street has become increasingly interested in profitability, efficiency, and execution. Growth still matters. Of course it does. But investors are asking more questions than before. How sustainable is that growth? How profitable is that growth? Can the company maintain performance if conditions change? These questions are influencing how businesses operate, and executives are responding accordingly. Perhaps the most fascinating part of this trend is that it crosses industry lines. Retailers are doing it, technology companies are doing it, manufacturers are doing it, healthcare companies are doing it, financial firms are doing it. Different businesses, different challenges at different markets. Yet many are reaching the same conclusion. The future feels less predictable, and preparing for uncertainty is becoming a strategic priority. You can hear this change in corporate language. A few years ago, executives frequently talked about disruption, expansion, scale, and growth opportunities. Today, you hear different words: efficiency, productivity, resilience, discipline, execution, flexibility. These aren't just buzzwords, they're signals. Signals that businesses are adapting to a new environment, an environment where surviving uncertainty may be just as important as capturing opportunity. What's important to understand is that this doesn't mean companies have become pessimistic. Far from it. Many businesses remain optimistic about the future. They continue investing, innovating, launching products, and pursuing growth. The difference is how they're approaching those opportunities. They're taking fewer unnecessary risks, building stronger foundations, and creating organizations capable of adapting to whatever comes next. In other words, they're preparing for multiple futures instead of betting everything on one forecast. That may be the biggest business trend Wall Street is watching right now. Not explosive growth, not rapid expansion, but resilience. The ability to perform well regardless of what happens next. The ability to adapt when conditions change, and the ability to stay strong when competitors struggle. So what is the new business trend Wall Street can't ignore? It's the shift from growth at any cost to strength at any cost. The realization that flexibility is becoming more valuable than overconfidence. The understanding that uncertainty is no longer temporary, and the belief that the businesses best prepared for change may ultimately outperform the businesses growing the fastest. Because in today's economy, success isn't just about how quickly a company can expand. It's about how well it can endure, and corporate America is quietly reorganizing itself around that idea. Wall Street has noticed, and that's why this trend is becoming impossible to ignore.